Anyway, I was actually saying that, I'm from the UK, but I've lived actually over half my life in Asia. And, I'd like to think that I can bring the best of both worlds, having invested in real estate in both Singapore as well as the UK. Now, I will be making the screen full size in just a moment, but I wanted to kind of have a little bit of early interaction with those of you who are attending tonight. There's quite a few clients that have actually invested in some of this asset class. But there's also quite a lot of new people that I've not met before, so it's great to connect with you. So I was trying to get a sense, because when I share about UK government-backed social housing and supported living, I would say the majority of people, when I first talk about this, either they've never heard of it or they're not really clear on what exactly it is. For Singaporeans, they often think it's the same as HDB, the Housing Development Board. But can I just ask you to, in the chat box, if you are, just reasonably familiar with what social housing and supported living is, could you just put a yes inside the chat box? And then I can kind of gauge, yourselves as an audience, how familiar you are with it. So I've got a few yeses coming in. That's good to see. Okay. Certainly with clients that I've shared this with in the past, will definitely have some understanding. Okay. Excellent. All right. Well, so far those ones who've put in, I mean, don't be shy to put a no in there. Actually, the majority of people, when I first share this, have never heard about it. So, okay. Looks like the vast majority have. Okay. Some of you haven't. So lovely. All right. Well, again, thank you very much for putting your notes in there. At least you now know where the chat box is, and we will be having a Q&A towards the end of the presentation. And you can put those questions into the Q&A towards the end, and I'll do my very best to answer those. Okay, so let me put the screen into presentation mode so you can see the full screen now. Okay, all right. Well, it sounds like most of you do know what social housing is, but for the benefit of those people that haven't heard about social housing before, let me just share a little bit more. So social housing is very different from HDB, the Housing Development Board in Singapore. So in Singapore, the government does a great job by providing affordable housing where you can buy at subsidized rates and basically get onto the housing ladder. The government will provide grants to help you get on there. So let's call that kind of like affordable housing, of which about 89 to 90% of Singaporeans live in HDB housing. Now, in the UK, we have something that is called affordable housing. And in fact, developers in the UK, if they build more than about 20 units in a development, by law, they have to have a certain percentage of the development as what we call affordable housing. Now, that is typically for first-time buyers, and the rates are reduced. And in the past, you could get higher loan-to-values if it was your first-time purchase to get onto the housing ladder. There's also affordable rent. So the developer may not always sell the property, but it may be rented out. And again, it's based on certain criteria based on your income levels. So that's affordable housing. So how does social housing and social housing supported living differ? Well, social housing in the UK is effectively free. It's free housing for people that have fallen on financial hard times. And it may be people that have lost their job and they can't afford to service their mortgage, or they can't afford to pay the rent. And in those cases, when they've fallen on financial hard times, they can actually qualify for free housing. Now, when we add the tag on of supported living, social housing and supported living is offering free housing to vulnerable individuals. And what I mean by vulnerable individuals are people that have special needs. So it may be somebody who's physically handicapped or mentally handicapped, autistic people. It may be orphans, elderly care people with no other family. It might be people that, such as domestic abuse violence, where they need to get out of a dangerous situation, have a roof over their head, and again, require social support. And the different profiles of people I've just mentioned require different levels of social support. So somebody who is acutely mentally challenged in that they may need full 24 round the clock support, whereas a domestic violence abuse mother and family may need a social worker coming in a few hours a week. So I hope just at the beginning, by clarifying and defining the differences between social housing and supported living and affordable housing and HDB property, helps to just clarify for the audience tonight. So I'm going to just go into sort of some macro things regarding UK government funded homes. So why is it that the UK provides free housing, and how can it? Well, when we look at the UK, I'm going to refer to it as a welfare state. And what I really mean by that is that it charges higher taxes than somewhere like Singapore. So VAT, which is the equivalent of GST, is actually at 19% in the UK. When it comes to income tax, the starting band is at 20%. It quite quickly goes up to 40% and increases to a maximum of 45%. Now, with those taxes, the government provides additional services, of which they offer free healthcare through the National Service, albeit you may have to spend a long time on a wait list if it's not something that is of a high urgency. Free education, and believe it or not, free housing. And again, when I share that the UK government provides free housing for qualified people, they sometimes look at me like I'm a bit of an alien, because certainly in this part of the world, it really is unheard of. Now, social housing has actually been around for almost 100 years, so it's nothing that's suddenly become a new policy. Irrespective of which government is in power, there's been a social, ethical and moral obligation to provide free housing to the needy. Now, actually in 2018, there was an act called the Homelessness Reduction Act. And this is actually a law whereby if you have become homeless for something like 56 or 57 days, you have the right to go to your local government, or the equivalent in Singapore of a town council, and apply for free housing, as you are now deemed a vulnerable person who's in no position to be able to either rent a property or buy a property in the open market. And again, this is for approved families that qualify for this kind of free housing. So when we look at the macro environment, the UK per annum has a shortage in supply of estimated about 90,000 per annum. Now, I've got a chart that shows the imbalance over the last 30 years, and it's gone from the best case was a shortage of about 50,000, and the worst case was something like 200,000. But every single year, the supply-demand deficit is never achieved. It's also estimated that there are over 261,000 empty homes. Those might be derelict homes, homes that people don't want to buy, properties that are on the market. And I've even seen statistics of much higher numbers than that. Now, one might argue to say, well, there's a shortage of property, and yet there's so many empty homes, and there lies an opportunity. And for the developer I'm about to share a little bit later, they will look at these empty homes to repurpose them into social housing. So last year alone, an additional 140,000 people increased in homelessness last year. It's a very sad statistic, and it may be quite shocking again to a lot of people out in this part of the world. The UK is one of the strongest economies in the world, and yet, like a lot of countries, the US is also a very good example. There are literally hundreds of thousands of homeless people. In fact, there's at the moment, it's estimated that approximately 1.2 million households are on the official waiting list for social housing. Now, those people, if they've applied and qualified but cannot get into a purpose-built social housing, will need to be put into temporary accommodation. Now, a temporary accommodation is typically a hotel or a serviced apartment, which isn't ideal for a family who may be going through some challenging times, and certainly isn't a long-term solution. I mean, last year, the government spent 1.7 billion on short-term accommodation. Now, to put this in perspective, it actually costs the government approximately 5 to 6 times the nightly rate to put somebody into a hotel or a serviced apartment, as opposed to the nightly rate in a purpose-built apartment for social housing. So you can see that the government is highly motivated to find more properties to build or to rent, because the cost per night is significantly lower than it is renting short-term accommodation. Now, I'll be going into more detail about the fundamentals of this investment asset class, but ultimately, the social housing supported living provides low risk, high yield, inflation hedged, long-term income. And so this has been very, very attractive to institutional investors, and you can see some of them on the right. A recent example from an Asian company, CK Asset Management, which is one of the asset management arms of Li Ka-shing from Hong Kong, bought a social housing operator or provider called Civitas Social Housing PLC last year for £485 million. And I was told actually earlier today by the developer that CK Asset Management have actually acquired another 2 operators and have invested over 3 billion to acquire more of this asset class. So let's get into a little bit more detail of what social housing supported living is, and I'll just read this part to be crystal clear. So social housing and supported living property investments are public and private property asset class. Investors, so if one of you was deciding to invest in a physical property and own your property, you would own the freehold property, and then it would be wrapped in a lease to a regulated, registered social housing operator, which is often referred to as a housing association, or in layman's terms, they are like the property management arm of the local government, or sometimes in the UK, the local government is referred to as a local authority. And again, for our Singapore audience, a local authority is really the equivalent of a town council. Now, the housing association not only leases the property, so they are the tenant, but it also takes full responsibility for property management, repairs, utilities, void periods, and provides support or care services to vulnerable people who are living in the property. So the actual individuals, those vulnerable people that we can see at the bottom of the slide here, they are not the actual tenants in terms of paying the rent. They are the individuals that have been approved by the housing association to be able to have free housing. So let's just make that clear. The housing association is your tenant. The people living in there are the vulnerable people that have been approved to have the free housing and the social support. So how does the money flow? So last year, the government allocated just over £25 billion to social housing and supported living. That budget is then allocated to the local authorities or the local governments, in which in turn, the local governments appoint regulated housing associations. So these are registered, regulated organizations, which I've mentioned before. We think of them as the sort of property management arm, where they're managing the physical asset, and in a lot of cases, they're also providing the care for the supported living. So local authority pays the housing association, and then the housing association pays the landlord or the owner of the property. So that's how the money flows. So ultimately, the funds are coming from central government and cascade down to the housing association and then directly to you, the owner of the property, on a monthly basis. Now, what I want to do is, in this table, is really compare some of the differences to owning a property in what we would call the private rental sector, sometimes referred to in the UK as the buy-to-let or an investment property, and compare with buying and investing in a property that has been designated for social housing and has the government effectively as your tenant. So some of the differences are, if you own a private rental property, you will be responsible for all of the repairs and maintenance, which, if the property is starting to get older, can significantly increase. If you've ever had to change a boiler in the UK, you can easily be talking £2,000 or £3,000 that could, wipe out 3 to 6 months of your rental profits. With social housing, all repair and maintenance is paid for by the tenant, that being the social housing or housing association. Finding occupants, well, if it's an overseas property, then you're probably appointing a property management company to find you a tenant. If it's in Singapore or your home country, you may well be looking to find it yourselves. In this case, the property, the day that you complete on purchasing the property, the 25-year no-break clause lease will start, and so you don't need to find a tenant. All the certification and building compliance for a buy-to-let, again, it is the landlord's responsibility. With regard to social housing, the developer, together with the housing association, has all the certification in place. Rental and occupancy rate is subject to voids when you're in the private rental market. The UK, like many countries around the world, has a very strong rental market, but that doesn't necessarily mean it's going to stay that way for years to come. And if things were to change and the economy weakens, people losing jobs, again, they may not be able to afford to rent. Conversely, when the economy is going down, one tends to find that social housing has a higher demand and so is very defensive during an economic downturn. When it comes to rental and occupancy rate, it's 100%. It's a 25-year no-break clause lease with no void periods, and it starts on the day that you complete your purchase. The rent source for buy-to-let is from the individual tenants. With social housing, it is effectively funded by the UK government. So with individual tenants, hopefully if the property management company has done their job, they've screened them and you're less likely to have challenges. But even with some of my properties, I had one tenant that literally just left the property and gave no advance warning. There are situations where, unfortunately, tenants do lose their jobs and they sit in the property, and it can take 6 to 12 months to evict them. And if you don't have tenant insurance, then you could be going 6 to 12 months with no rental income, but still having to pay a mortgage. And the tenancy length, typically in the UK, it's a 1 to 2 year lease. With the social housing, it can be up to 25 years. So some very significant differences when it comes to considering owning a property, whether that be in the private rental market or buy-to-let, as I've called it, or the social housing. So let's talk about the developer called Yield Investing. I've worked with this developer now for about 4 years. They've been in the social housing sector for now 10 years. And one of the things I like about them is that they're not only a developer, but they also have a sister company with common shareholders who are a housing association or an operator. And it's very unusual to find in this asset class an organization that both builds and renovates the property and then is operating it as well. Usually it's one or the other. Now, yield investing are a developer, so they also distribute or they also sell the properties as well to potential investors like yourself. Basically, specialize in the area of social housing, supported living, healthcare sectors. So what they do is they sell property that offers long-term, high-yielding income funded by UK government programs, which gives investors a hands-free property ownership experience. And really what I want to emphasize here is that for anyone that's on the call tonight, if you've owned properties over a period of time, invariably you start to find that they're a bit like, each of them are a bit like carrying a baby. Some require more attention than others. And as you grow a portfolio, the time it takes and the money it costs to maintain those properties can start to eat into your time and energy and costs. Whereas when we look at the social housing, once you've bought the property, everything is looked after, and all costs related to it are borne by the tenant, that being the housing association. So you really have a true armchair investment. So let's have a look at really the highlights. So what are you investing in? You're investing in typically a terraced freehold property that has gone from being maybe a rather dilapidated, rundown property, which is brand newly renovated in line with the Housing Association's strict guidelines, which I must say are actually stricter than the private rental sector, and it comes fully furnished. The property is then wrapped in a 25-year commercial lease with full repair and insuring lease with no break clause and no void periods. Now, this might sound a bit strange because ultimately you are investing in a residential property. But interestingly, with this asset class, it is wrapped in a commercial lease. Now, for those of you who've invested or owned commercial property, you will know that generally speaking, the tenant is the one that has to pay for all the repairs and maintenance. And it's the same here. Although you own a residential property, it's actually wrapped in a commercial lease. So it is the tenant that has to pay for all those additional costs, not the landlord. The starting net yields are at 9%. The landlord never pays for or deals with repairs, maintenance, tenant damage, utilities, letting fees, management fees, and void periods. Now, the rent is revised every year based on inflation. So I mentioned earlier that this is inflation hedged. Well, your rent is directly correlated to inflation. So at the moment, inflation has now gone down close to about 2%. And so every year, if it were to stay like that, your rent would be adjusted upwards 2%. It would never go below 0%. So if rentals in the open or private rental market were to go down, yours will never go down. There is a ceiling on a maximum of 4% increase, but for 50 years, the average inflation rate has been around about 2.8%. Last year was a bit of an anomaly where it did go up to 10% for a little while. Now, when you invest in one of these properties, you can sell the property at any time. You could hold it as long as you like, or alternatively, if you wanted to exit, the developer will actually buy back within 3 years and give you a 10% appreciation on what you purchased it for. So if you purchase it for £100,000, in 3 years' time, the developer will buy that back at £110,000. There's another option as well, whereby if you own multiple properties and the combined value of your portfolio was £500,000 or more, if you wanted to exit in 2 to 3 years when the developer offers a buyback, then because you have a larger portfolio, they will share more of the profits, and that would equal to between about 20 to 30% uplift on the price of your overall portfolio. And whilst, of course, you're holding the property for those 2 or 3 years, you're enjoying a very attractive net yield of 9%, which grows each year. So let's have a look at a few examples. Now, we're not talking Buckingham Palace, as you can see. These are classic terraced houses that have been brand newly renovated. I'll show you in a moment some pictures of the brand newly refurbished properties inside. But take a look at this. It might surprise you that a 2-bedroom terraced house can be bought for £98,000. In fact, there are some properties that the developer has that start from as little as £75,000. I've mentioned that these come with a 25-year lease with no break clause and no void periods. So at a 9% starting yield in the first year, that would equate to £8,820, which is equal to £735 of rent per month. And if you were to sell it on the buyback within 3 years, they will buy back at a 10% appreciation. So that would be £107,800. And the table at the bottom shows you over time how the annual rent increases and what the yield or net yield would be based on a 50-year average of increasing it with the inflation at 2.84%. Now, when you look at these figures, you'll actually find by year 10, the accumulated rent over the 10 years will have actually paid 100% of the property. And that doesn't include your capital growth that you will achieve over time. But if we go to the 25-year column, what we can see is that the rental income by then is estimated at 17,273. That's a net yield of 17.6%, or a 311% return over 25 years purely on the rent. So in effect, you'll have made over 300% return, not including the capital uplift. So again, you can see here very predictable income streams. And I often share with clients that one of the beauties of predictable rent is you know exactly how much you're going to have. You know what you're going to be achieving. You don't have the associated variable costs that can suddenly wipe out your profits in the private rental sector. And so one could argue to say, well, what is better? Looking at capital growth, which is looking into the crystal ball and hoping that in the future you are able to sell at a time when the property prices are high and the market is moved in your direction. But what if it hasn't? Capital growth, we are looking to the crystal ball. Typically, yes, over the medium to long term, property prices will rise. But here, what we've got is very, very predictable income. And at the end of the day, when we look at our ROI, a very attractive ROI. In fact, if you look at this, if you imagine that you have a 9% net yield for 3 years, that would equal a 27% return purely on the rent. If we then take into consideration the 10% uplift with the buyback, that would then increase the 27% to 37%. And if we divide that by 3, then we would be achieving just under 13% ROI per annum, which for many people, when we look at this as a perceived low-risk investment in real estate in the UK, where ultimately the government is your tenant, getting just under a 13% return for a low-risk style of investment, I think most people would say is a very attractive return. This is another example. This is actually a 3-bedroom unit with a purchase price of £120,000. And again, same thing, 25-year lease. The first year rent is $10,800. That equates to $900 a month in the first year. And if you take the optional buyback, it would be bought back at £132,000. So there's a couple of examples. Here we can see some internal finishings, and the finishings, once you've pretty much seen one property, you've seen them all, because pretty much the fixtures and fittings and the flooring, the same materials, because the developer is buying in bulk and obviously then has a much better economy of scale. But you can see here, again, if you imagine somebody who's fallen on hard times, they're financially in trouble, or they may be not only financially in trouble, but have special needs where they need social support. Here they've got a brand newly renovated property where they can have the support that they need, hopefully get back on their feet, integrate back into society. So I actually am very passionate about this, because not only does it make very good sense from a commercial aspect, from an investment perspective, but it has a very, very strong social impact, where you are having a profound impact on somebody's life that can really change their lives and help them get back on their feet. And ultimately, you have been their benefactor by being able to invest in a property so that there is one more roof over a vulnerable person's head, and get them out of a situation where they could either be homeless or in temporary accommodation, which is not suitable for long term. Now, here's just a list of properties that are available at the moment. They range from £98,000. And as you go down towards the bottom of the table, there are some small apartment blocks that go for £219,000, and the one right at the bottom for £800,000. In fact, there are some larger blocks still that go for several million. So irrespective of what your budget is, there are properties that start from very affordable prices, and there are some that are starting between £75,000 to £80,000 as well. So the process when investing into this asset class, if you're going to be actually buying the physical property and owning the freehold, is first of all, of course, choose your property, complete the reservation form, and basically pay a £5,000 deposit. Engage with a solicitor, and we can basically work with you with solicitors who are familiar with social housing and the lease agreements and the sales and purchase contracts. You review the report. If you're happy signing the sales and purchase agreement and the lease agreement, transfer the balance to the solicitor, exchanging contracts, and typically that process is going to take 4 to 6 weeks. And then within 1 month of completion, you should be receiving your first month's rent. So it's a typical conveyancing process. So I believe, we're just coming to the summary of this first part of the presentation. So let's just summarize. So if buying and investing into your own freehold property, it is a completely hands-free investment once purchased. It takes 4 to 6 weeks of some work, but after that, there's really nothing that you need to do. There's no repairs, maintenance, or service charges. The UK government funded leases up to 25 years with no break clauses. Rents cannot go down, they're only upwards based on inflation, albeit capped at a maximum 4% increase. As I mentioned, it's a really good ethical, social impact investing, where you're really having a major, profound impact on an individual or family's life. And effectively, you're the owner of a freehold property offering high yields, low risk, inflation hedged, and a long-term income stream, which you may wish to keep for your retirement. You may wish legacy planning and passing it on to the next generation. Really, there are many things that you could potentially do with this. You could take a buyback and take the profits of that 10%, or if you have a larger portfolio, an uplift of 20-30% in capital growth, as well as the rental income, and then reinvest it into another property. So you could keep circulating in that way as well. Okay, I'm just going to pause. I've actually had a bit of a flu recently, so my throat is a bit dry. So I hope so far so good. Okay, so as mentioned at the beginning, I'm discussing multiple ways to invest into social housing. The first one, via the other developer called yield investing, is for investors that would like to own the asset and get long-term rental income paid by the government. The Alderley Group also build affordable and social housing on behalf of the government. But rather than investing and owning a property, the structure of this investment is a loan note or a bond. In the UK, it's frequently referred to as a loan note, but in a lot of other countries, it's referred to as a bond. So in this case, you're actually lending money to a developer who in turn uses that to acquire land, build on it, and effectively it's sold to the government. And in return for lending the money, you receive a very attractive yield or return. And I'll go into a bit more detail, but I just want to make sure you're clear. The first developer is if you're investing and you prefer to buy and own the property. For this one, it might be that if you have lots of properties, you might find that having something shorter term, entry level is lower, but still the underlying asset class is social housing. So the Alderley Group have a very interesting business model. When I first got to know about it, I was quite amazed. Now, I'm going to summarize how this business model works because it's different from a traditional developer. And I'm always looking for developers that have a long track record, they're experienced in the industry, but they have something a little bit different from a traditional developer that really makes it very special and ultimately reduces the risk. So how does this developer operate? Well, what they do is they work closely with local authorities or the local governments, and they've built up relationships with planning departments. And they've asked those local authorities, where do you need social housing? The local authorities, because they have built a relationship up with the Alderley Group, will let them know these are the towns and the cities that we are in very short supply. So the Alderley Group then go out, look for land, and they look for land with planning permission, which is critical for those people who are not familiar, and I can expand on that later. They then acquire the land and sell that land back to the local authority, and they make a profit on that. Now, when they sign the agreement with the local authority, they're signing an agreement to find and sell the land, but they're also signing a second agreement, which is to construct the property as well. Now, when they construct the property, as soon as they start building, every single month they bill the local authority the cost of the build plus a 30% profit margin, which basically means every month they are cash flow positive and making profit. Now, this differs hugely from a traditional developer that will be going out to tender and find land. Very often they're buying the land and then they have to apply for planning permission. And sometimes planning permission can get bogged down in a lot of bureaucracy, and it can really delay the time it takes to be able to get to the point where they can start building. So here, the developer is buying with the planning permission, so that risk is taken out. They've got a guaranteed buyer, which is the government, and then they're building on behalf of the government and getting paid every month with a 30% profit margin. With a traditional developer, they will typically start selling the property off plan. And if the market's really hot, hopefully they sell the properties very quickly and they can make a good profit margin and move on. But what we've seen in the last couple of years is the fact that with interest rates going up, the affordability to take a mortgage has rapidly gone down. Fewer people can afford a mortgage, so sales have slowed down significantly. And this has hurt a lot of developers to the point where some have gone bust. So with a traditional developer, it might be that they would need to sell, let's say, 75% of the units before they actually start making a profit. And if it's a large development and sales are slow, who knows, that might take a year or two before they've even broken even, let alone making a profit. So you can see the difference here with the Alderley Group. They have a low risk model. They're making a profit when they sell the land, and they're making monthly profits as they build, with a guaranteed exit, with the government contractually agreeing to buy the property. So I really do like this business model, and one of the reasons why I'm very comfortable to share this kind of opportunity with potential investors like yourselves. So I've already mentioned that the Alderley Group have a 25-year experience. They're a family business based out of the Liverpool, Manchester area. Now, they've been operating in the real estate and developer for 25 years, but more recently they created the brand the Alderley Group, and that started in 2019. And to date, they've completed or have in the pipeline 13 projects. And again, I've touched on this before, that with social housing development, not only are you investing into a very strong low risk model, but it has a much deeper, profound impact by really impacting vulnerable people's lives. So what is the opportunity? So basically, as I said, this is a loan note or property bond where you are lending money to the Alderley Group. Investors are focused on fixed income and can start with a £10,000 investment and achieve returns of 12% per annum, which is paid at 1% per month. While those seeking higher returns can opt for 15% per annum, paid at the end of a one-year term. Now, there are bonuses. So if you invest a larger amount, invest £100,000, there is an additional 1% bonus. And if it's £200,000, there is a 2% bonus on top of the figures that you can see on the left. Now, this is a secured loan. The Alderley Group offers a 12-month investment commitment with a secured first charge on assets, ensuring your investment is effectively protected with minimal risk. So that's really a summary of what the investment is. It's short-term, one-year fixed income investment with a very attractive rate of return, with peace of mind that it is secured by way of a first charge on the developer's assets. So the Alderley Group do provide a complete turnkey solution. So under the Alderley Group, they basically source, find, and acquire land. Their sister company, which is called Complete, which is their construction arm, then does all of the building. Now, the risk reduction in the model reduces critical risks and avoids planning uncertainties, market fluctuations, or sales risks. And really, to expand on what I was saying before, one of the things that can really delay projects is if planning permission gets bogged down and the developer has to go back and forth and keep reviewing and amending their planning application. And that sometimes can go on for years. And that can be a major issue because at that point in time, the developer is unlikely to be getting any income, but they're incurring costs. Market fluctuations. Well, in the open private market, what you're going to find is that properties goes up and down, rentals go up and down. Whereas in this market, again, it's a guaranteed exit to the government. So there's no sales risk. You've got a guaranteed exit to the local government. And the Alderley Group have partnered with major housing associations. You can see some of them on the bottom right-hand side. And for those of you not familiar with Homes England, basically Homes England is funded by the UK central government. They literally have hundreds of millions of pounds allocated to them. And in turn, to certain housing associations, they provide the funding that then goes to developers such as the Alderley Group. So again, ultimately, the funding for building these properties is coming through central government. So again, just addressing some of the risk. There is a first charge on the developer's development in favor of the investors. Now, this is administered by a regulated organization called a security trustee. The security trustee holds the title deeds of the development on behalf of the investors. So in the very unlikely scenario, there is a default by the developer, the security trustee can step in, repossess the property, sell it off to recover the capital back to the investors. And it works in a very similar way to if you're applying for a mortgage and the bank approves your mortgage. To protect their liability, they're going to take a first charge on your property. And as long as you service your mortgage, everything's fine. However, if you went 2, 3, 4 months without paying your mortgage, at some point, the bank has the legal charge or the legal right to repossess your property and sell it off to recover the liability of the loan that you are no longer servicing. In addition, there's an absence of senior debt. Now, as I've explained, as they start building the property, every month they're billing the local authority the cost of the build plus a 30% profit margin. So with no senior debt, or this is really another technical word for bank financing, when the bank basically, if they were to be financing the construction as an example, they're going to take a first charge, and then investors would have a lower ranking on the charge, and the bank would have the first charge. So when there's no senior debt, then that is removed and investors are ranked first on that charge. And when we look at the cash flow of this kind of developer, you know, cash for most businesses is so important, and it doesn't differ for the development real estate industry. They have a very strong cash flow because of this business model, which again reduces risk for them as a developer and in turn you as an investor. They also take out other comprehensive risk management practices, which includes insurance coverage, extensions of time, contingency planning to mitigate unforeseen external factors such as weather disruptions. Now, the estimated revenue of the developments in the pipeline at the moment is estimated at 106 million by 2026. As I mentioned, they have a healthy profit margin and cash flow where they have a 30% built-in net margin billed every month. And the cost of actual borrowing, when we look at the estimated net profits based on the actual interest paid on these loan notes, equates to just 4.84%. And as I mentioned, sustained cash flows, strong cash flows give it a very good foundation for long-term growth. Okay, we're getting close to the end. Let me just see if it will go through to the next one. So, next steps. If you were to want to invest in this, then in fact, in both of these investment opportunities, I have a nice email that will summarize the opportunity. These will include comprehensive due diligence packs, brochures, information, fact sheets, and so on. Of course, if you'd like to have a one-to-one call or meeting with myself, I'd be delighted to do so. And once you're ready to make an investment, it's actually a very straightforward filling out an application form together with some AML and KYC documents, which is typically proof of address and proof of ID. And usually the turnaround time is just a few days to get the investment live. The Alderley Group, I found, have been extremely responsive and dedicated to providing personalized support throughout the investor period, ensuring investors are informed and engaged at every stage as well. So that brings me to the end of the Alderley Group. But what I wanted to do on the last slide was really just do a comparison of both of these opportunities of investing into this really fascinating asset class of UK government-backed social housing and supported living. So what I've taken is two columns. Obviously, one is buying and owning a social housing freehold property, and the other is investing into the social housing bond. And when we look at the returns, the annualized yields for owning the property is starting at 9%, but remember that's adjusted upwards every year based on inflation. With the housing bond, you can choose which option you'd like, and basically it's fixed, so you know exactly what you're going to get, as it says on the tin, and you can choose between 12 to 17%. The investment term, well, for owning a property, that really is up to you. You can sell it whenever you want. You could never sell it and have a lifetime of long-term income, or you could participate in one of the buybacks from the developer and enjoy a 10% uplift, or 20 to 30% if you own a portfolio of over $500,000 or more. For the social housing, it's a bit like a fixed deposit of sorts. It's a fixed 1-year term. The investment entry level for the freehold property is £75,000, which is roughly 130,000 Singapore dollars. For the bond, it's 20,000 entry level, or in pound sterling, it's £10,000. Application time, well, I mentioned before, to purchase and go through the conveyancing process, if everyone's working efficiently, we're looking at 4 to 6 weeks. For the bond, it's typically about 4 to 5 days. It's very easy, very straightforward application process. So if time is of the essence, these are, not labor intensive at all. When it comes to taxes, I have to sort of say that I'm not a qualified or licensed tax advisor, but I can mention that when you are buying a property, you are subject to SDLT or stamp duty. With a property under £250,000 in the UK, it's 0 basic stamp duty. But if you're buying as an investment property and you're non-resident, you would be paying roughly 5% on a property below £250,000. There is income tax and there is CGT or capital gains tax. Now, if you were owning more than one property, there are arguments that buying through a company structure can be more tax efficient. It can be easier for legacy planning and a whole variety of other benefits, which is a completely different topic. But again, let me know if you're interested, because I can share details about that as well. Now, the beauty of the bond is that there are no costs or taxes associated with this. If you're a Singapore or Malaysian resident, basically there's no entry fees, there's no management fees, and getting paid on interest on an investment in Singapore and Malaysia is not subject to income tax in either the UK or in Singapore and Malaysia. So 100% of your cash goes into the investment, and you receive back 100% of your cash with the coupon interest. Risk level is always a little bit subjective, but I think most people would say that buying a property, especially in a country like UK where there's a strong rule of law, that Singapore is based on the UK rule of law, real estate, as I say, is typically seen as a low risk investment asset class. And I think when we couple that with the fact that this kind of property is a freehold property with a long-term lease where the tenant is the government, where you've got no variable costs and associated risks, that actually reduces the risk level even more. And I would argue to say, in all the years that I've been in real estate, I have not come across a lower risk form of investing into real estate. So at the end of the day, if you still find that too risky, I would suggest maybe putting your money into a fixed deposit. But of course, the returns will be a lot lower. Social housing, it's interesting, this one. Hear me out for a moment. Very often when I first talk about the bond and I talk about the returns, naturally people think, well, that's a very high return, it must be very risky. Well, one of the keys, again, is looking at the developer, looking at their track record, and ensuring that they have been in business and gone through different cycles. Now, this developer, as I mentioned, has been in business for over 25 years. They've gone through various economic cycles. Usually you find roughly every 10 years you go through a high and a low, And if they can manage their business and get through those highs and lows, they've demonstrated that they know how to manage and run a development company. Now, I'm not saying that that's any guarantee of success, but it is a major consideration. Now, if you think about it, when you're going into a bond like this, you're investing in a developer at a very early stage. And so there is what we call development risk. Now, if the developer were to default and, let's say, go bankrupt, you do have legal recourse through the first charge, and there is inherent value in the development that the security trustee can effectively liquidate to get back your assets. So one of my arguments to clients in this part of the world who seem very comfortable to buy off-plan property from developers is ask yourself the question, if you're buying off-plan and that developer goes bust and you put a 10, 20 or 30% deposit down, what recourse do you have? Now, sometimes there may be an insurance on the first 10%, and anything above that, effectively, you would lose. And if you don't have an insurance on the first 10% deposit, then if that developer goes bust, then you've lost everything. So my argument is, if you are comfortable investing in off-plan property with a developer, then in some ways, I would argue to say that depending on the quality of that developer, you are exposing yourself to more risk than actually with one of these fixed income bonds, where at least you have recourse if the developer does default. Currency. So buying the property with the yield invest is bought in pound sterling. With the housing bond, there are multiple currencies, which includes the Singapore dollar, US dollar, pound sterling, yen, and the euro. So if you are based in Singapore, which I think the majority of the callers are tonight, you are not exposing yourself to any kind of currency risk whatsoever. Now, both opportunities are government backed. So if you're owning the property, the government is paying your rent. If you're investing into the bond, the developer is paid by the government to get the land and also to build the property with a guaranteed exit. And the exit options, well, I've mentioned earlier, you can sell whenever you like, you can hold as long as you like, or you can opt for a 3-year developer buyback. And with the bond, it is a 1-year fixed term. So that brings me to the end of the presentation tonight. I hope that that hasn't been sort of too overwhelming, but I hope it's clear, whereby I'm presenting two very different ways with two very experienced developers to access this very unique asset class, which historically was only available to institutions, but has now been made available for retail investors as well as family offices and institutional investors. In fact, I talked to all three of those kind of clients, and whether you're looking to buy or invest in an individual unit or an individual bond or your family office or institution, this can actually cater for all those different profiles of investors. So that brings me to the end. It's just 1 hour since I started, but let me open up the floor to questions. I'm going to open up the chat box. For those of you who came in a bit later, the chat box should appear towards the bottom right-hand side of your screen. And please feel free to start putting in some questions there. I'm just going to grab a quick drink. Please don't be shy, because usually what happens, I find, is once one person starts answering questions, suddenly there's an avalanche of questions. So who's going to be the daring one and go first? While you may be thinking about some questions, let me share some quite common ones with regard to bonds. It's a common question that somebody might say, well, if you're paying a 12% return, why doesn't the developer just go to the bank and surely they can get cheaper financing? And one of the challenges with that is the fact that as soon as they go to the bank is going to want to take a first charge. That would then put you as investors in a less secure position. And it puts the bank really in control of the development. The developer starts to lose control of that development. As I shared before, though it's quite a complicated calculation, the actual cost of borrowing, when you look at the amount of interest they're paying per annum, based on the net profits that they're making, equates to just 4.84%, which is actually cheaper than taking construction finance at the moment. So to answer that kind of question, it's actually cheaper to raise funding this way. Plus, they have a ready supply of cash, so that when they find a piece of land that they can get at a very attractive price, very often the person who's got the cash and who can move quickly is the one that actually gets the deal. So, Sam, you've put a question about the bond. You mentioned government pays the developer. That's correct. Yeah. Yes, the bond. So that's right. I don't know if you joined in right at the beginning, but effectively, the Oldley Group is building and getting paid by the government. So when they buy the land, they actually sell that land back to the government on what we call a back-to-back deal. And then they have a contract with the local government to build. And every month that they bill the local government the cost of the build plus a 30% profit margin. So, Mr. Tan, 2 to 3 years buyback option. What about 10 years buyback option? Well, let me share a little bit about why is the developer offering a buyback option. In fact, roughly every 2 to 3 years, the developer will go back to all of the investors and say, we'd like to buy back all of the properties. And the reason they're doing this is that they are going to aggregate all of the properties that the investors wish to sell, and they're going to package that and sell it to an institutional investor. So for the developer, it's very good business acumen, because they will have sold you the individual property at the beginning, and then they are going to sell it again on a second sale and give you an option. It's not mandatory, if you'd like to participate by then buying it back with a 10% uplift if you have less than $500,000 portfolio, or it will work out at 20 to 30% if you have more than $500,000 portfolio. Now, institutional investors typically are looking at portfolios minimum of 25 million, but as interesting enough, as we get into larger portfolios of 50 to 100 million, there are more and more investors or institutions that then become interested. So over a 2 to 3 year period, the developer basically has an opportunity to have sold enough properties whereby they can go back to the investors and say, if you'd like to participate, we will give you an uplift, and they will sell it to an institution. So it's a great way for you to have an option if you wanted to. Again, it's not mandatory to exit every 2 or 3 years, and you could take the profits and potentially reinvest that into another property and keep maximizing your ROI. So, Joe, let me just see if I haven't missed anything. Sorry, I may have missed a question there. So Sam's asking, follow-up question on the bond. The developer already gotten the land in their block. So what happens? The developer works hand in hand with the local authorities or the local governments, and is, whilst looking for pieces of land, is asking the planning departments, where do you need the land? The planning departments let them know. They then acquire the land in those areas that the planning department, local authorities require, and they do a back-to-back sale back to the local government. So it happens simultaneously, actually. It's not that the developer is buying the land and then hoping that they can sell it to the local authority. They only buy that land once they've got confirmation and signed an agreement with the local authority that they will buy the land, in addition, contractually, to for the Alderley Group to build and the actual property as well. I hope that's answered the question. Joe, so thanks for the question. Any consideration regarding choice of location, i.e. which town to purchase the social housing property? Well, yes, I mean, there are properties all across, particularly in the north of England, although the developer has actually just recently acquired something in the London area. Now, this is going to sound very strange when we talk about real estate, because most people will have heard of location, location, location. And when it comes to this kind of investment, basically with a commercial lease, the value of your property is actually valued primarily on the rental yield, not the location and not the bricks and mortar. It's actually the rental yield. Now, the higher the yield, then the higher the valuation. So over time, what is happening with a commercial valuation is, if you bought a property, let's say at £100,000, and let's say you were getting a 10,000 annual income, you've got a net yield of £10,000. But let's say in 5 years' time, just for the sake of argument, let's say it's gone to £15,000 annual rent, the valuation of your property would have actually gone up to £150,000. So that's irrespective of location. So one of the nice things about this kind of investment asset class is that actually you don't need to be too concerned about the exact location, because the valuation is driven by the actual yield. It gets a little more, that's a big conversation, but maybe I'll take it offline into a little bit more detail. Okay, let's see, Mr. Tan again. So follow up with my question 2. The buyback option available to investors is every 3 years. Well, basically, actually, you can participate whenever there is a buyback. You can actually sign a buyback option, which is within 3 years, or you don't have to sign a buyback option, but any time that they are looking to exit to institution, the developer will reach out to all of the investors and ask whether you'd like to participate. But roughly every 2 to 3 years, then there will be a buyback option for you. Okay, Sam, on the bonds, since it is a back-to-back, the developer, not to sell to the local council, thus the owner of the land is the local council. The developer turns the builder. The development turns builder then. Yes. The straight answer to that is yes. Developer, yeah. So basically, the developer finds the land, does a back-to-back sale to the local authority or the local government, and at the same time signing a contract to build the property as well. So yes. Good questions. Okay, Darren, thanks for the question. How many years or tranches of the bond has been issued and fully redeemed by the Alderley Group, i.e. any defaults so far? So there's no defaults so far. They've just issued the third bond. I've invested personally, so I've actually seen how it's been working. Basically, they've never missed a coupon payment, and they've never missed a capital repayment at the end of the term. So it's like an open bond. What happens is, until they have fully subscribed, the date that you transfer your funds and it arrives in the developer's account is when the 1 year term starts. And then obviously 1 year later, you can decide if you'd like to roll the money through. If the bond is still going, you can roll it through to the same one, but usually within a few months, it's already been fully subscribed. So if you do like it, you can roll it through to their next bond. And Actually, when you take a 15% annualized return and you keep reinvesting and compounding your interest into the investment, in 5 years' time, you'll have doubled your money without the uncertainties of what you can potentially have in the open market. Okay, on the bond, it is a 1-year term, that's correct. Does it translate the project can complete in 1 year? Okay, so it depends obviously on the size of the development. Some developments could complete in 1 year. Other developments might take an average of, say, 18 months. Now, it starts to get a little bit more technical because if you think about what I've just said, the developer is raising funds and they're using those funds to acquire the land. They use their own money also to acquire the land, but at the same time, they do a very quick back-to-back sale to the developer. When they start building, they don't need any funds because the local government is paying every month the cost of the build plus the 30%. So let's say to acquire the land and sell it to the back to the local government takes somewhere between 3 to 6 months. In actual fact, if your money's in the bond for 1 year, they can recycle that money maybe 2, 3, maybe even 4 times, which significantly increases their returns and profits. And in return, the more profitable the developer is, the less likely there is for a default. So it really is a very good model. Okay, Mr. Tan, I understand banks do not finance such low-risk freehold property investments. Wondered why banks stay away from such asset class. Now, Mr. Tan, I know that we have been speaking about this, and since we have spoken, I have found lenders that will lend on this asset class. So it's a good question because one of the things that has been a challenge in the past is getting financing. One of the reasons why some, banks have been, let's say, cautious to lend is the nature of what the house is being used for. So let me just expand on that. You're the owner of the property, you take a loan. Now, the rental is such a strong rental yield that you should never default. But then again, you can do with your rental whatever you want. And if you don't, if you have a mortgage and you're not using your rental income to service your mortgage and you've got other challenges, let's say you default on your mortgage, then a vulnerable person no longer has a home and they would need to be effectively evicted out of that home, and the housing association would need to put them into another home. And it's not very good PR for the banks to foreclose on a property which is housing a vulnerable person. It would go down very badly in the press. And so this is just one of the reasons why banks have been a little bit reluctant. But I can say that I've now spoken to several lenders who are prepared to lend on this asset class. So just to be 100% transparent, this developer, because the properties are sold so fast, once they're listed, typically within 1 or 2 weeks they're being sold, they do require cash buyers. They don't want to be waiting for you to apply for a mortgage, and that can take 2 or 3 months in the UK, and it can be sometimes a painful process. So they only will allow cash buyers to buy the property, but once you've bought it, then if you wish to, you can refinance it, take the equity out, and then of course, either reinvest or do whatever you wish with the funds. Okay, Darren, in terms of the repayments for the bonds, it would be into our actual SG bank accounts for the monthly 12% or yearly 15%, or would we need to open up a bank account held in trust accounts in the UK? So the answer is it can be paid directly into your Singapore bank account, no problems. So that's what I have, and I have many, many other clients that have done that as well. Okay, I would like to follow with my question one. Okay, maybe I haven't answered question one clearly enough, Mr. Tan. Could you, let me see if I'm just scrolling back. Replacement costs, landlord responsibility. Okay, I know we've had some conversations about this because you've had a look at the agreements, and basically we have not had a situation in hundreds of properties where the owner has had to pay for any repair and maintenance. So as I mentioned, all repair and maintenance, are subject to be paid by the actual landlord, in which case this is the housing association. So things like replacement cost as well. If it's a replacement cost of furniture, again, same thing, that the housing association would be paying for those replacement costs. Okay, some very good questions. I'm conscious of time, but I'm more than happy, to answer questions, because I think this really brings to the forefront any concerns, and obviously I'll do my very best to answer those questions. But I hope, as I've shared, that you've seen really what a wonderful asset class this is. As I say, not only from an investment case, but also from a positive social impact case. It really is a win-win all round. Okay, all right. Well, looks like questions of, oh, we've got one more. Okay, for the bonds, if the developer goes under liquidation, may I ask, are there any protections for the investors, e.g. for the full property purchase, there is a first charge? So yes is the answer. So with the bond, so we just make sure we're clear, we're talking about the Oldley Group and the social housing bond. There is a third party regulated company called a security trustee that's appointed. The security trustee holds the title deeds of the developments on behalf of the investors. So the security trustee is effectively looking after the interests of the investors. And in the unlikely scenario of a default, the security trustee has the legal right to step in, repossess those properties. When I say properties, developments, because let's say it might be halfway through being built, but the value of that development has gone up over time. When you buy the land with planning permission, it goes up in value. As you start building, it goes up in value. So the valuation is constantly increasing. And if they needed to, they would do a valuation and effectively sell off the development. A new developer would come in, take over, and the funds that have been received by the security trustee would then be dispersed back to the investors based on how much capital you've invested. Okay, social housing bonds regulated by the Bank of England? The answer is no, they are unregulated. These investments are for sophisticated and accredited investors. Now, it doesn't mean to say that this is a scam or something. There are investments that are regulated that are very good, and there are investments that are regulated that are not so good. But it's a good point that you need to be a sophisticated or accredited investor. Now, that's based on the UK definition, which is actually very different from the Singapore definition. The income has just changed. So the definition of a high net worth sophisticated investor in the UK has changed from £100,000 annual salary to £70,000 or net assets of £250,000. Now, with net assets of £250,000, most people that own a property in Singapore already qualify. So I hope that answers that question. Social housing bond yields remain the same regardless of the currency one invested in. Yes. So you will be paid, whether it's 12, 15, or 17%, whichever option, regardless of the currency. Now, if you happen to decide, if your base currency is Sing dollar, and let's say you think that the yen is very weak, which actually it is extremely weak against the Sing dollar at the moment. It's at about a 43% low over the last 5 years. If you don't mind or are open to taking currency risk, you could actually invest, let's say, in Japanese yen. You would get paid in Japanese yen. You would get paid your interest rate at whether it's 12, 15, 70%, whatever you've chosen. And at the end of the 1-year term, you could keep it in Japanese yen. But if the Japanese yen has appreciated against the Sing dollar, you could repatriate it back into Sing dollars and you will have increased your returns. But of course, the yen might get weaker and it could wipe out all of your returns or some of your returns. So for some people, they might say, well, I prefer to invest in my base currency, let's say Sing dollars, and receive my interest in Sing dollars, and I get my capital repayment back in Sing dollars and have no currency risk. And others might want to hedge a little bit and have multiple currency investments. Okay, I think that's answered that one. Would like to understand if any concerns on getting qualified for any of these investments having an Angolan citizenship. Yes, I know we've touched on this, Francisco, and thanks for touching base. If you are interested, I would have to ask. I haven't had a client who is a Angolan citizen. Now, I know that you're a Singapore resident at the moment, and that basically would, I'm sure, would be a tick in the right direction. I'm assuming you probably have banking facilities also in Singapore, which would be a tick in the right box. So I can't give you a categoric answer at the moment, but I can actually find out very quickly, and probably by sometime tomorrow, I can actually ask, in theory, whether somebody who is an Angolan citizen could qualify. So watch this space and I can let you know. All right. Every time I think we've run out of questions, a few more come out. So I'm here as long as you need be, but I appreciate, I respect people's time if you need to sign off. I do encourage you, you can see my contact details there. And I would really like to meet up with each of you on a one-to-one basis so that we can build a relationship. I always believe that two key things in my industry and working with clients is building trust and credibility. If you ever want to read a book, hope it doesn't put you to sleep, but I co-authored a book which is called Gold Nuggets for Entrepreneurs, Lessons That Change Your Life. And I wrote a chapter on really long-term longevity in a sales career, having worked for many years in sales, and discuss about what I think are key factors for honest integrity in selling. And I hope that clients who are on this call, can even testify. I'm not the kind of person that's going to be shoving a product down your throat. It's all about building that trust and credibility, understanding you as a client first and foremost, what is the right kind of investment for you. And hopefully that builds the bridge for a long-term relationship where we can work together, as I say, for the long term. And at the same time, you will be then comfortable to refer clients as well. So I look at it much more at working a long-term relationship and having that over a long term rather than just trying to make a quick sale, irrespective of whether it's the right kind of investment for you or not. Okay, alrighty. Jess, my colleague, has also put into the chat group my contact details. So if you want to cut and paste those, if that makes it easier for you to keep my details and give me a call or an email, then again, I'm more than happy to do so. Excuse me, I'm going to need to blow my nose. As I said, I've come down with a bit of a flu just lately. Okay, it looks like no more questions. I've said that 2 times already. Let me just scroll down. I think we're all good. So it's 9:30 now. So thank you again very much for your attendance tonight. I hope that you have found it useful. And again, I'd really like to encourage you to reach out to me with any more questions. I'd be delighted to have, whether it's a face-to-face meeting, a virtual call, or just a question through WhatsApp or email. I'd be delighted to help. So thank you very much. Enjoy the rest of your evening, and I'll look forward to seeing you on our future webinars in the future. Thank you.
Thanks,
and
Richard.
thank you.